Welcome to the Deep Dive, where we transform complex reports and data into clear, actionable insights just for you. Today, we're taking a deep dive into Nasdaq Inc.'s second quarter 2025 financial results and their recent Form 10Q filing.
Exactly. And our mission today is really to unpack what these, pretty detailed financial documents reveal about Nasdaq's performance. We'll look at its strategic direction and how it continues to evolve, as a global technology company. You'll hopefully walk away with a well-rounded understanding of their latest achievements and what it means for their future outlook, getting far beyond just the headlines.
Okay, let's get right into it then. Nasdaq just reported some, frankly, eye-popping numbers for Q2 2025. How did they perform on a high level? What's the big picture?
Well, what's really fascinating here is just the sheer scale of the growth. Total revenues, less those transaction-based expenses, hit $1.3 billion for the quarter.
$1.3 billion.
Yeah. And that marks a 13% increase over Q2 2024. And even if you look at it on an organic basis, that's still a strong 12% rise. It's significant growth.
Right. So what does this all mean for their profitability? That kind of top-line growth must flow through.
It absolutely did. If we connect this to the bigger picture, their operating income surged, really surged, by an impressive 34.2% to $568 million in Q2 2025.
34%. Wow.
Exactly. And this translated directly to the bottom line. Net income attributable to Nasdaq more than doubled. It jumped by 103% to $452 million.
Doubled.
Doubled. And diluted earnings per share saw the same astounding 103% increase, reaching $0.78. This significant growth truly highlights their operational efficiency and, frankly, their market strength right now.
That's a huge jump. And I hear their subscription-based businesses are also contributing significantly to this overall picture, more predictability there.
Absolutely. That's a key part of the story. Their annualized recurring revenue, or ARR, reached $2.9 billion. That's growing 10% year over year.
Okay.
What's even more interesting, perhaps, is their annualized software as a service, SaaS revenue. That increased by 13% and now represents a substantial 37% of that total ARR.
37%.
Yeah. It really shows a strong pivot towards those sticky, predictable revenue streams. Less reliance on market volatility,
Makes sense. Okay, let's unpack where this impressive growth is actually coming from across Nasdaq's different business lines. They categorize them into capital access platforms, financial technology, and market services, right?
Precisely. And their solutions businesses, which is the combination of capital access platforms and financial technology, they grew by 10% in Q2. Solid growth there. Within that, capital access platforms, this includes data and listing services, index, and workflow and insights, saw revenues rise 9.8% to $527 million.
Okay, and here's where it gets really interesting for companies looking to go public, I imagine. Nasdaq extended its listing leadership for 46 consecutive quarters. 46. What does that mean in terms of new companies joining them?
It means they welcomed the highest number of first-half listings since 2021, so a real uptick. In Q2 alone, they had 79 U.S. operating company IPOs raising over $3.5 billion.
79 IPOs in one quarter.
And interestingly, this included 41 SPACs, showing a bit of a rebound there, perhaps. Overall, new listings on the Nasdaq stock market reached 194, and they also showed strong momentum in their switch program, attracting nearly $50 billion in market value in Q2.
50 billion switching over.
Yeah, with notable names like Shopify, Thomson Reuters, and Kimberly-Clark moving their listings to Nasdaq. It's a strong validation.
What about the total impact of those listings, the overall size?
Well, the Nasdaq stock market now boasts 4,238 listed companies as of June 30th, 2025. That includes 914 exchange-traded products, ETPs. Their combined U.S. market capitalization is approximately $34.6 trillion. Huge number.
$34.6 trillion, just enormous scale.
It is. And meanwhile, the Nasdaq Nordic and Baltic exchanges, they host 1,148 listed companies with a combined market cap of about $2.2 trillion. So a significant global presence.
Okay, and their index business, how did that perform?
Index revenues jumped 17.2% to $196 million. This was primarily due to higher average assets under management, AUM, and those ETPs tracking Nasdaq indices that reached $745 billion as of June 30th.
745 billion AUM.
Right, and also increased trading volume in Nasdaq 100 index derivative contracts played a role.
Got it. What about workflow and insights? What's happening there?
Revenues here increased by 5.2% to $133 million. This was driven by growth in their analytics business, particularly investment and Nasdaq alternative data sales. helping institutions make decisions.
Okay, let's shift to the financial technology segment. This covers financial crime management technology, regulatory technology, and capital markets technology. How did that area do?
It saw a healthy 10.3% revenue increase to $464 million. So solid growth across the board there.
Right. I'm particularly curious about their financial crime management technology. This seems like such a critical area now.
It absolutely is. And this business, it's powered by their Nasdaq Verifin solution, which uses consortium data and AI. It saw an almost 20% revenue increase.
Nearly 20%.
Yeah. They signed 3 new enterprise clients, secured 2 upsells, and added 46 new small to medium bank clients just in Q2. And perhaps most interestingly, they signed their first proof of concept project with a European Tier 1 bank.
Ah, so expanding internationally.
Exactly. It indicates strong international expansion potential.
Okay. And for regulatory technology or RegTech?
They continued their success there. Axiom SL signed a new client and a cross-sell, along with 34 upsells, including a significant renewal with a large bank. Their surveillance solutions also gained traction. They signed 6 new clients, including 2 market operators and a European regulator, plus 33 upsells. Lots of activity.
Definitely sounds like it. Moving to capital markets technology, what's driving their momentum there? The core tech for markets.
Well, this area is seeing really robust client demand. It's benefiting from this broader market modernization trend, everyone upgrading their systems. Their Calypso solution signed 2 new clients and 37 upsells. Market Technology secured 2 new clients and 24 upsells, and a significant development is signing 3 clients to their new 4th-generation platform, Nasdaq Eclipse.
Eclipse, okay.
Yeah, including 2 fully managed services mandates and 1 AWS-hosted SaaS deployment, so pushing towards cloud and managed services.
Gotcha. Okay, finally, the market services segment. How did that perform?
Record net revenue. It rose 23.3% to $1.090 billion. Really strong performance.
$1 billion in revenue just from market services. What stands out to you there?
Well, the record U.S. cash equities and derivatives revenue is a highlight. Nasdaq's exchanges achieved record U.S. cash equities volumes, and it was a quarter that also saw record industry volumes overall. But here's a memorable detail. The Russell reconstitution. Big trading event.
Right, always huge volumes then.
Exactly. Nasdaq's closing cross successfully executed 2.5 billion shares in a stunning 0.871 seconds.
Under a second. For 2.5 billion shares.
Under a second, representing a record $102.5 billion in notional value. It just demonstrates their incredible technological capacity and efficiency under pressure.
That's amazing. Okay, so beyond the top-line numbers and segment performance, let's pull back the curtain a bit. What's happening with Nasdaq's expenses? How are they managing their finances underneath all this growth?
It's a good question. Looking at operating expenses, they actually remained relatively stable overall, increased by just 0.3% to $738 million in Q2.
Only 0.3% with all that revenue growth.
Right, but there are definitely shifts within that number that show where they're investing.
Okay, so where are they putting more resources? What does that tell us about their priorities?
Well, we see increased investment in technology and communication infrastructure. That's up 14.9%, and it's driven primarily by cloud initiatives and software licensing. Makes sense. Occupancy expense also rose due to colocation data center growth, and marketing and advertising were up slightly, mainly due to higher client incentive spending linked to that increased IPO activity. And merger and strategic initiatives expenses saw a significant increase, but that's primarily due to the Adenza integration costs.
Right, the Adenza deal. And where are they seeing efficiencies or maybe some one-time impacts that help keep the overall expense growth so low?
A key factor is that restructuring charges decreased significantly. Their previous divisional realignment program was completed back in September 2024, so those costs are off the books. And they're actively pursuing further efficiencies through their new Adenza restructuring program. They're targeting $140 million in annual cost savings by the end of 2025.
And how close are they to that target?
They've already actioned $130 million of that through June 30th, so they're well on their way to realizing those synergies.
That's impressive progress. So how does their balance sheet look overall? What about debt levels and shareholder returns? Are they keeping things healthy?
Yeah, their liquidity looks quite healthy. Cash and cash equivalents stood at $732 million as of June 30th. They've also been actively managing their debt. They repaid $400 million of their 2025 notes in Q2. And they repurchased $279 million of other notes back in Q1, which actually resulted in a $19 million pre-tax gain.
A gain from repurchasing debt.
Yeah, likely buying it back below face value. They also have $1.5 billion remaining under their share repurchase program. They bought back 1.23 million shares in Q2 at an average price of about $81.50. And for shareholders directly, cash dividends declared per common share increased to $0.27 in Q2. That aligns with their stated policy of providing regular and, importantly, increasing dividends.
Okay, disciplined capital management alongside the growth. What about their clearing operations? That seems like a really unique, maybe less understood part of their business. How does that work? Acting as a central counterparty, what's involved?
That's right. It's a critical function. Nasdaq Clearing acts as a central counterparty, or CCP. Essentially, it guarantees trades in various derivatives markets. It stands between the buyer and seller, ensuring the trade completes even if one side defaults. It's crucial for market stability.
So they take on risk there. How much resource do they have backing that up?
A lot. As of June 30th, they held over $12.1 billion in clearing member default fund contributions and margin deposits. So that's money from the members themselves. Over $5.2 billion of that was held in cash, showing the robust collateral they have in place. Plus, Nasdaq committed $157 million of its own capital into what's called the liability waterfall.
Their own skin in the game.
Exactly. And it's worth noting, they've recently streamlined things a bit. They transferred their Nordic power futures business and settled out all their seafood derivatives clearing positions, so focusing their efforts.
Interesting. And with all that complexity, money flowing through, how do they handle the inherent risks? Credit risk, liquidity risk?
They have a really comprehensive risk management framework, as you'd expect. For instance, in clearing, they mitigate credit risk by holding that cash collateral primarily at central banks or investing it in very highly rated institutions and government debt. Very conservative. They manage liquidity risk by maintaining highly liquid funds, ensuring they can always meet payment obligations. And they do use derivative instruments, but strictly for hedging financial risks, like foreign exchange exposure, not for speculation. For example, they mentioned their euro notes are designated as a hedge against foreign currency risk related to some of their foreign subsidiaries. It's all about mitigating, not taking on unmanaged risk.
Makes sense.
Yeah.
Okay, moving beyond the numbers and operations, let's explore the people side and the future outlook. How does Nasdaq structure its corporate governance, particularly for its leadership, to keep everyone aligned?
Well, their governance structure is quite clearly defined in the filings. For non-employee directors, the annual retainer is $90,000. And there are additional fees for committee service, for instance, $25,000 extra for members of the Audit and Risk Committee, reflecting the workload there. Directors are also expected to meet specific stock ownership guidelines within 4 years.
Oh, like holding company stock.
Exactly. The chairman needs to hold stock worth 6 times their annual equity grant, and other directors need to hold 2 times theirs. It ensures they have a direct financial interest aligned with shareholders.
Right. And how do they incentivize their employees, especially the executives, to drive these kinds of results we've been discussing?
They have a pretty robust share-based compensation program. It includes restricted stock units, RSUs, which generally vest over time. But more interesting, perhaps, are the performance share units, or PSUs.
How do those work? Are they tied to specific goals?
They are. And what's fascinating is how they're designed. The payout is based on Nasdaq's total shareholder return, TSR, compared to 2 different peer groups. One is a specific index, the S&P 500 GICS 4020 index, and the other is the broader S&P 500 index. So it directly links executive pay to how Nasdaq performs for its shareholders relative to the market and its peers.
So not just absolute performance, but relative performance too.
Correct. And there are some interesting controls built in, too. There's a payout governor, which limits the award issuance to 100% of the target if Nasdaq's own TSR is negative, no matter how well it did relatively. And there's also a price cap at 250% of the grant date price used for calculation purposes. So it prevents sort of unlimited windfalls and manages the potential expense. Shows built-in risk consideration.
Very detailed. Okay. Finally, we saw some mentions of regulatory matters, always important in this industry. Is there anything significant listeners should be aware of?
Yes, the company did disclose an ongoing inspection by the European Commission. It relates to a potential competition law concern regarding Nordic financial derivatives trading. Now, Nasdaq stated they are cooperating fully with the Commission.
But the outcome is uncertain.
Exactly. The duration and the ultimate outcome, including, any potential remedies or fines, remain uncertain at this point. It just highlights the complex regulatory environment they operate in globally. It's part of the business for a company of this scale and scope.
Understood. Well, we've certainly taken a comprehensive deep dive into Nasdaq's latest financials and operations. From those record revenues and really strong growth across all segments to their strategic debt management and those detailed compensation structures, it's clear Nasdaq is a very dynamic and evolving force in the global capital markets.
Indeed. Their increasing focus on technology platforms, that predictable recurring revenue we talked about, and disciplined capital management, it really paints a picture of a company navigating what is still a complex macroeconomic environment with a very clear strategic direction.
Yeah. And this whole deep dive leaves me thinking about something. Nasdaq keeps emphasizing its role in improving liquidity, transparency, and integrity in the global economy.
Hmm.
So how might their strategic investments, particularly in things like AI, cloud, and that financial crime tech, how might that reshape not just their own future, but potentially the entire financial system in the coming years? It's something to really ponder, isn't it?
Absolutely. That's a great point to end on. The ongoing shift to digital and cloud-based solutions is undeniable. And when you couple that with the increasing sophistication of financial crime, well, their technology-first approach could have incredibly far-reaching implications. It's really not just about their own numbers anymore, but about the actual infrastructure they're building for the future of finance.
A fascinating perspective. Thank you for joining us on this deep dive today. We hope you feel more informed and maybe ready to explore some of these topics further yourself.